Do you want your business to grow faster? Are you open to new and out-of-the-box ways to drive revenues and increase value? How do you imagine the most successful entrepreneurs and business leaders double, triple, or expand their businesses tenfold or more? The answer is Deals. This is a weekly podcast featuring conversations with business owners, executives, and leaders as we reveal behind-the-scenes details that give you, our listeners, the confidence to pursue your own deal-driven growth. On this show, we discuss a huge variety of deals, everything from large, complex mergers and acquisitions, capital raising, joint ventures, strategic alliances, real estate, affiliate and sponsorship deals, franchising, and more. My name is Corey Kupfer, and I've been supporting deal-driven growth for businesses for over 35 years as a successful entrepreneur, professional negotiator, and attorney. My goal is to help you strategize, plan for, find, and complete deals that will help your company grow faster. Welcome to the DealQuest Podcast. Let's get started. Gerry Hays, JD QAI, is an entrepreneur, investor, educator based in Bloomington, Indiana. He currently serves as managing partner of Doriot Markets and the founder and CEO of Doriot Venture Labs, a firm focused on early stage investing. At Indiana University's Kelley School of Business, Gerry teaches students how to launch and fund new ventures, bridging academic theory with real-world startup practice. He's founded multiple companies, including Kingmaker Foods, which was acquired, and Homye, and has been active in many early stage investors, up to 75 investments. He's also appeared on Shark Tank. So there's a lot we can talk about. Gerry, I'm super excited to have you on the show.
Thanks for having me, Corey.
So listen, I want to get into all your extensive experience in not only as a founder, as an investor, as a teacher. But before we go there, I want to take you back to when you were a little kid growing up, maybe 10, 12 years old. What did you want to be? Because I'm guessing a venture investor and founder and educator might not have been it back then, but you tell me.
Oh, yeah. I really didn't have any aspirations of what I wanted to be when I grew up, other than I wanted to get a law degree because my uncle was a lawyer and I respected him immensely, still do, of course. So I always wanted to get a law degree, but I played with Legos all the time. So I was just one of these guys who's always playing around with Legos. So it was a very creative time for me during those early years.
Yeah. So, it's interesting because there's many folks who start out in law and then move on to the business side or the investing side or things like that. And frankly, many of our colleagues who stay in law are not very happy with it. I happen to love what I do. So maybe I'm a little unusual. I'm just curious, did you actually practice for a while? How did you evolve to do what you do now?
I practiced for about 20 minutes. So what happened was I graduated from college and I got a fellowship with the governor's office in Indiana. That put me into sort of the political government affairs arena. So while I was working in the governor's office, I went to law school in the evenings. Then I was in government affairs following that stint, graduated from law school, passed the bar, and then thought I'd give it a shot. And literally probably 6 months in, I was like, this is not going to be a fit for me.
Yeah. I love it. One more question looking back. What was your first deal of any type? It could have been early in your career, or maybe it was something, when you were even younger, anything you consider a first deal?
Well, my first startup was when I was in college. I had a painting business and I would go find houses to paint and hired college kids to paint them in the summer. My first startup investment was my life savings of $25,000 at the age of 27 and lost it all. It just crashed and burned within a few months of when I made that investment. So I learned very early on about how to avoid the fool's tax from here on out. And so I've been giving a lot of my time to teaching others how to avoid paying the fool's tax.
So on that investment, you don't have to name any specific names or whatever, but what type of company was it generally and where did it go wrong?
So it was interesting. It was a technology that was going to process hazardous waste. So you wouldn't have to put hazardous waste in the landfill. So as part of my work at the governor's office, I was running lobbying for the Department of Environmental Management. So I was very familiar with the intricacies of hazardous waste landfills and how problematic they are. Okay. So this is a really great technology. This guy was putting this deal together to build a facility in Indianapolis, Indiana, licensing technology from these folks out in Alabama. And he just was one of these founders who he just couldn't cross the chasm. He just didn't know how to make it happen. And when you invest, you're really investing in the founders more so than the idea. And I just was a bad picker of founders at that point in time.
So it sounds like, I mean, one thing you did right, there is a wisdom that says, invest in things you understand and know. So you did that part right? You knew,
Hmm.
you understood. But yes, I mean, investing in management and picking the right team and whatever, that's the other side of it. That certainly you learn that lesson. So talk to us, your journey from there. I mean, so that's interesting because you made an early investment that didn't work out. Talk about like your founder journey versus your investor journey. I mean, for a lot of folks, they are founders first, right? Then maybe they sell a company and then they're like, okay, now I have some money and maybe I don't want to start a new company, or along with starting a new company, I'm going to, do some venture investing or angel investing. But it sounds like you got into the investing side early. I don't know if you continued to invest after that one deal or that put you off for a while, but talk to me about that founder journey and the investor journey and how that played out.
Yeah. So on the investment side, I didn't make an investment for, a good 10 years after that.
Okay.
So I switched over to becoming a founder. And so when I left the practice of law, it was the dot-com days, right? So we can remember 1998, 1999, internet was going crazy. I thought that the internet was going to disrupt real estate. So I thought, I'm going to build a company around creating an online real estate company so people can pay, so they would pay fees, they wouldn't pay commissions. And so I started a company called HomeYa.com. And I found this small company in Indianapolis called IndyFisbo. FISBO means for sale by owner.
Yes.
They had about 25 lawn signs out and around Indianapolis. And I went to their offices and I said, hey, I want to buy your company. And of course, they wanted millions of dollars. Like, I don't have millions of dollars, but we worked out a deal anyway. Switched it over from just listing your house online, but for us to handle the transactions in a central clearinghouse. And we just went crazy. We went from zero to $1.8 million in a matter of about 24 months. We within a year, became the 11th largest real estate company in Indianapolis by transactions. And yeah, I was having trouble raising capital here in the Midwest. And I didn't think to go out to California to raise that capital. And that kind of stuck with me, that why is it so hard for me to be able to raise capital? And that's the problem that's led me to, what I'm working on today is how to solve that problem for founders who have a lot of ambition. They're really talented. They're not connected in the right circles. They don't live in the right geographies. How do you back them? And at the same time, how do you give people who back them an opportunity to make a lot of money doing it in a low risk way?
So with that company, the challenge in raising money. So, how did that hamper the growth? And then you eventually sold that company, right? That was the exit.
I did. So I was a little frustrated. So I decided to go to a bank and raise $125,000, put my house on the line, or my wife, our house on the line.
Yes.
She was 7 months pregnant with our first. Yeah. And, so I'm putting all my chips in. I bring my 2 tech developers on full time. I'm making an acquisition in Ohio to replicate what we did in Indianapolis. And we're going to open up an office in Orlando. And that was all done in August of 2001. Okay. So fast forward a month later and, everything just goes in the wrong direction, including all the activity stopped with us. People weren't selling their houses anymore. It was just a really tough period. So where we had cash coming in and cash in the bank, all that sort of evaporated, trying to keep the lights on during this very tough period. And then I did end up having an opportunity to raise money, $1 million the following year, 2002. And the lead fund had to pull out because one of their LPs couldn't make the deal happen. So it was very, just kind of one of these unfortunate situations. So I ended up selling the company to Help You Sell Real Estate in 2003.
Got it. Yeah, it's fascinating. I mean, I've been around. I was practicing back during that time, and I remember doing all these private placements for all these .com, whatever, there's something, it was like a watch.com. There was and in those days you can get those kind of domains like watch.com, and everybody was going to, they were just going to sell that product online. And everything was moving online. And then of course, we had the bubble burst and all that kind of stuff. But it was interesting. I mean, I won't go into this in detail, but because I've mentioned this story before, but I also remember the investors back then. I had a client actually in the real estate related field, but they came up with a great idea. They were originally National School Reports. They became the School Report, where they originally started pre-internet. And they were providing, like, the second most asked question after price is how are the schools, right, in any given area. So they had a report. In the old days, it was originally somebody would fax in an order and they would snail mail a report on somebody's thinking about moving to Greenwich, Wilton, or Stamford, Connecticut. they would do a report on the schools in those 3 districts, average, student-teacher ratio, different programs, percent of kids that go to college, all this data that they manually gathered from the schools. And they got some VC money. And then the interesting part was, and again, I won't tell the whole story, I've told it before, but is they realized that, wait, they're a data company, right? When the internet was coming in, like they have to go online, and their VC, which was, was a known VC, wasn't investing in internet back then. They're like, we don't invest in internet. So they went up, and we had to cut a deal that basically take them out, and we gave them a warrant for a certain amount or whatever. And then, it ended up to be a very bad move for that firm not to invest in internet, because we did end up selling the company, and sort of, my guy got like a double bite of the apple. He sold, he got some equity, they sold, et cetera. So it was very interesting times back then. Very interesting times.
Yeah. Well, it was kind of the wild, wild west for sure.
Yeah. All right. So continue on the journey. So you sell that company.
So I sold that company. I was invited to come down to Indiana University to teach venture capital as a new course that they wanted to start.
Yeah.
So I've been there since. But, I went to school at IU, got my law degree at IU. Now I'm teaching at IU. So like a major part of my life is tied to the university. And then I started a food business with my brother. It was in the fried chicken business of all things.
Okay.
We became a distribution company to start. He handled everything internal. I handled everything outside. So I was out selling a fried chicken program to Southern grocers. So if you can imagine a Yankee going down to the South and telling them that their fried chicken is no good, it took me 2.5 years to get my first sale. But once we got that trust built, and then we went from $0 to $10 million in a matter of like 3 years. So a total of 5 years from getting to 0 to 10. And that was a bootstrapped company. And so we moved into manufacturing, and, the costs got higher. We had to go raise some money to keep up with it. And I just kind of thought that this is not really the business that I wanted to be in long term. I wanted to move down to Bloomington. I wanted to kind of focus on this area that I'm focusing on. So I was able to get a recapped out through a private equity buyer. And the business continues. My brother runs it. He loves it, and I was able to get my side out of it, and I'm just as happy. So.
Right. Love it. So now let me just, pull back to a very high level, just the concept of raising capital, right? And the difference, obviously, you got angels, you got friends and family, you got angels, you got, VC, you got private equity, right? All that kind of stuff. I do a bunch in the wealth management field. There are sovereign wealth funds that are coming in now, to invest. Yeah. So just, in your journey as a founder, and now obviously somebody who, this is what you focus on, teaching people, and you have your venture lab, all that kind of stuff. I want to go to a very basic question, because it's always an interesting thing. And there's, like in the entrepreneurial community, there's this sort of pressure, maybe an assumption that, like real entrepreneurial companies scale and they raise capital and they, they should be unicorns. But the far majority of businesses are not that. And some of them do really, really well. So like that decision on whether you should raise capital, what are the factors? What's the upside and the downside? Who's appropriate for it? Let's start at that very fundamental level.
Yeah. It starts with there are different types of entrepreneurship, right? There's entrepreneurship through innovation, where you're literally trying to create something brand new market, new product. That's an expensive endeavor. You're going to probably have to raise outside money. And if you're going to raise outside money, there's an expectation that it needs to be a big opportunity, right? There's entrepreneurship by imitation, where you see an existing market that's out there and you can go in there and do it better, cheaper, faster, maybe raise a little bit more money, but that could be a lifestyle business. And that could be one where a medium-sized business where you're doing 10, 25, $30 million a year, throwing off 4 or 5. You may never want to sell that, right? And the investors may never want to sell that. There's also entrepreneurship by acquisition, right? Where you can go find a company to acquire and then bring in streamline services or new models into that business. That's going to require outside capital, of course. And there's expectation of an exit at some point, where your investors want to get in, stay with you for 5 to 7 years, and then sell. And then there's entrepreneurship through licensing, which is franchising, right? Where again, you could have a small investor group, but maybe you just hold on to a lifestyle type of business. So it really depends on the kind of company that you're looking to build. But I would argue today that if you take a look at the cost of starting a company from scratch compared to what it was 20 years ago, it's a fraction. And it's only going to get cheaper with AI agents, with no code, with access to cloud services. You would have needed to raise $5 million 10 years ago to create what you can create in a day today for $50, right? It's just insane. And that's only going to increase. So what I believe is going to happen, we're going to see a confluence of a couple of things. We're going to see it very cheap for anyone to get into the business of entrepreneurship. You don't need to raise millions and millions and millions of dollars. Maybe you need to raise that one small round of capital, $500,000, something like that. And that could sustain you because your operating costs are all scaled through AI, right? And then the other part of this is that I'm seeing what I believe is going to happen is tokenization, where exits and liquidity will happen where you can tokenize your equity, and these companies can be tracked in essence based on their profitability, right? So you could buy and sell tokens based on how the company's performing financially. I think there's going to be this sort of mini stock market through tokenization, whereas like the New York Stock Exchange, those are for the hundreds of billions of dollars of size companies. But I think the SEC is trying to work out a smaller, more liquid market for the very small cap types of opportunities. So it's a really interesting time to see, what's happening, both with the democratization of being able to start and the democratization of ownership through tokenization.
Yeah, that's a fascinating point. And, and if we look at the trends previously, this combination of the evolution of technology, right, to make it, because you're right. I mean, listen, I remember even for me, and I'm not like, I run a law firm, right? Like when I first started my firm, I mean, we literally had servers in a closet. We had to run wires, like it was an expensive endeavor, especially for me as a young startup attorney who started without, I worked at a big firm, medium-sized firm, but I didn't have a client base that I was taking with me. So I was starting with nothing, paying my rent on credit cards, doing everything you weren't supposed to. And, now I had to invest in building out an office and, whatever. And then, 10 years ago, when I split up a partnership and relaunched the firm, it was a few laptop computers and, $500 a month in cloud computing. And that was 10 years ago, right? So it's fascinating. And then when you combine that with the moves, listen, the SEC, the regulations have changed, whether it's equity crowdfunding, and other ways that investments have become more democratized. It used to be much more so that there was a feeling that if you weren't, at a certain level, accredited investor or qualified, that, you had to be protected. And there was all these roadblocks to smaller investors getting in. And that started to shift already. And what you're talking about, it can be the next level of it. So, yeah, any thoughts on that evolution?
Yeah, so my contention with the SEC, and I've worked with them on a number of occasions about this issue, is that, we want to get rid of the accredited investor rule, no question about that. But there's got to be some sort of education mechanism that people understand the game that they're getting into, right? Venture investing is a very high risk, high return game, and diversification is that key component. And I liken venture to poker, right? And you have to play a number of hands, and you're going to throw away a lot of your hands for the few hands that are really good, really big winners for you. And then you just got to really bet heavy. And that's how you win your pots, and that's how you play the game where you can return more than you lose, right? And that's what I'm trying to do, is almost systematize a sort of mindset of poker around venture investing so people can play lightly, not with a lot of money, but if you can bring a lot of people together to play that game, everyone's taking a very small amount of risk, but yet, what you're really hunting for are those companies that can give you 100 to 1,000x return, right? You want to turn $100 into $100,000, right? Well, if you got into Stripe, you would have turned $100 into $3 million, right? Or if you had $100 in Amazon today, that'd be worth $5 million. That's the game that you really want to play, but how do you play that in a way that you don't lose your shirt doing it?
Yeah, and talk to me a little bit about the psychology as well, because, I've seen it with investors. We represent hundreds of financial advisors, for example, right? Mm-hmm. And one of the biggest things they do, some people say, why do I need a financial advisor? I can put stuff in this, whatever, forgetting the conversation of whether advisors help you, do better in the market or not. Just the psychology of it sometimes. Like so many people, I'm an ideal client for financial advisors because I get it, right? I have my money in most of my money in a diversified portfolio. Market goes down, market goes up, black swan. I don't worry about it. It's there for the long term. And then I have my piece, which I play with and invest, right? And I don't get emotional. I don't get upset. I'm not doing panic calls to my advisor, but many people do. And then, it's similar with investors, even though it may not be, and and what you're talking about, a huge amount of money. The joke often is that the smallest investors are the toughest one, are the ones you have to, coddle and handle much more, right? Because they're less professional around their money. It means more to them, et cetera. So, talk to us a little bit about that psychology and that education that needs to happen, because even the best funds, 7 out of 10 of their investments are, probably going to go under, 2 are going to do okay. And then they hope that they have one that, that's a big hit, right?
Yeah. And so it's all about framing, right? So for example, if you talk to someone and say, look, what is your budget? Is it a $500 budget? All right, you make your decision. That money is allocated, it's gone. And then let's subdivide that and work on it. So in our game, A venture staking, it is, okay, what you want to do is build a large portfolio of founders who are just getting started, right? So it's about discovering the breakouts. So put $10 into 25 founders. We are finding these founders that are just getting started. They're looking to raise 100, 150,000 just to get going. Give them $10. You with, 3,000 other people are giving them a starter money. We call it the ante, right? And then if that founder has a breakout and then like, oh, we've really discovered something. Now we're going to go raise $3 million. Then you get invited to the party. So if a VC is coming in and they're going to put money to work in that company, you get invited to the party and then you get to ride that up, right? And so that's what you do. So out of 25 deals where you give someone $10, you may only see 3 deals that are worth investing in. Right. But that's better than putting $1,000 into 25 deals and, only to find, 2 or 3 that are going to win. You know what I mean? So it's almost you're gamifying this discovery process, and you are learning a ton by watching these founders give you updates, things that are happening with their businesses. I mean, it's just there's a lot of education capture when you're backing founders and you get to pay attention to how they're building their businesses. You learn a lot.
Yeah. Love that. So that's a good segue into Doriot, and talk to us, a little bit more about the company and the business model and who you serve and that kind of stuff.
Yeah, so the model is exactly this. We're trying to make venture investing accessible, but a winnable game of venture, right? And it's all based on this one premise that the right to invest or the option to invest in a company in the future that's winning is more valuable than over-investing in something today, right? So the smartest thing you can do with your money is to lock in some optionality and then wait and watch and discover to see if this is in fact really true or not. You're not blown up by all the marketing and all that. You're a little bit more discerning. Give a little bit of runway and then see if it's really a real deal. Where we're taking that basic model is that we're going to bring this to universities. So if you can imagine, you've got Indiana University, for example, that they've got 70,000 students across all their campuses. We have 800,000 alumni, right? And we're going to help them create what we're calling a venture staking arena, where students can apply for, a grant between $25,000 and $100,000. You could be an alumni who you're looking at starting a company where you can apply for a grant, and what you do is you make a pitch, and then everyone else can decide, well, I'll give you $10, I'll give you $25, I'll give you $200, I'll give you $1,000, right? And when we take that, we put that together into a grant, and then no strings attached grant. If that founder comes up with something really interesting, then you invite all your venture stakers to invest in your equity round at 10x your venture stake. So it's sort of that game of poker, but it's all based on shared information, shared risk, and shared prosperity. So imagine all the education and innovation that we can capture within an ecosystem of a university between alumni, faculty, and students. Every university is thirsting for new ways to drive innovation, to become and remain relevant in today's fast-changing economy, where you got to learn to be an entrepreneur to, in the future. It can't just, we're not training you for jobs that were here 20 years ago, right? The future is a lot more uncertain. So it requires a whole new set of skills that we need to train students on. So this would be a great, arena for them to do that.
And then really that key point of getting access to, right, invest in that, in that round. Like a lot of the issue, there's all kinds of stuff, right? There's the education, there's being able to, get the money, there's psychology of it, there's all that stuff we started talking about. But also, traditionally, right, the best opportunities, access has been limited, right? To, you're a student, you're a smaller investor, whatever. Traditionally, you don't have access to those opportunities, even if you wanted to, even if you were aware of them, and even if you wanted to invest, right, there wouldn't be that opportunity to do so in the past.
Yeah, no, that's exactly right. And the example I give all the time is everyone knows who Sam Altman is. What they don't know that he worked for Y Combinator. And this is before he was an accredited investor, okay? He didn't even meet the qualifications, but he was given an opportunity to invest in Stripe in 2009, $15,000. That investment's now worth $650 million.
That's amazing.
Right? If you would have subdivided that 15,000 divided by 100, so you could give, 150 people or whatever that same opportunity, then you would create 150 millionaires by that one investment, right? So it's how do you get into those opportunities where you can put a little bit of money to work, where you could get that kind of exponential return. And they're out there, and they're going to continue to be out there because the law of venture continues to prove out that 90% are going to fail, but that 10% that win are going to win big.
Yeah. Yeah, especially as technology continues to evolve, it's just unbelievable the pace of innovation. It just keeps, every time, at least for me, I feel like every time you think, wow, it's accelerated so much from what it used to be, it just, not only does it continue to accelerate, but it actually accelerates at a faster and faster pace, right?
Yeah, it is. And, we have to rethink what our economies look like. And I believe one of those tenets is going to be the ownership economy. But if you could own tokens in 150 companies generating $300, $400, $500 for you a year each, you could build a nice little, lifestyle by owning companies that are operating by AI agents primarily, right? It's just, I think about all these crazy scenarios that are going to be happening in the future, but that's where we're on the frontier of this, right? We have to imagine what the future looks like. And my motivation is to bring as many people along in this process as possible, helping, invent what the future looks like.
Yeah, love that. Let's take a break from the show for a minute so I can tell you about an incredible resource my team and I have put together for you. Secrets of Deal-Driven Growth, Creative Ways to Grow Your Business Even in Challenging Times, is a powerful ebook that helps you take DealQuest podcast episodes and apply them to your own life and business. This is the ideal tool for anyone looking for creative ways to grow as deal makers, and you can get yours now. It's as easy as heading to coreycupfer.com/workbook and downloading your copy. While you're there, you can also consider joining our dynamic deal-driven community of founders, experts, small business owners, and entrepreneurs. Now back to the show. Let's talk about, it's interesting to me. So I had a good friend in college who was a math and science genius, right? And he was funny because he barely went to class, and then, he was taking like these non-Euclidean geometry, math 411, right angles aren't 90 degrees kind of courses, and just brilliant guy, right? And I'm a political science guy, right? Social science guy. I'm planning on going to law school. So we used to have these debates back in college about, he always it was like, technology and innovation changes of what rule the world, what changes the world. And I would be like, yes, acknowledged, but really, the social and political environment also govern, whether it's by regulation, whether it's by adoption, whether it's by what kind of, restrictions might be put in place. And, it was the kind of thing we could sit and debate for years, a few times a night. And, it was, and it was a fun thing to do back then. But I do think it's an interesting conversation, right? Because obviously there needs to be social acceptance and adoption. There needs to be regulation, and structures and markets and things like that keep up with the technological innovation. So, in terms of sort of that conflict sometimes or alignment sometimes, talk to me a little bit about what you see happening there, in this environment and in the future that you see, whether it's tokenization, whether it's democratization of, all that kind of stuff.
Yeah. The thing that I guess is interesting right now is that if you take a look at what's happening in Washington, D.C., right, between Wall Street, Silicon Valley, and D.C., this is the first time in the history where all three parties are kind of working together inside sort of creating what are the future game plan that might be. I get sometimes concerned that the game will get rigged in their favor, and there's going to be a lot of people left out of this. And, I think we have to do what we can to resist making this such that we don't make room for everyday people to have that American dream, to invest and get into really good deals. And we're not just talking about the crumbs at the bottom of the table.
Yeah.
Right. So we've got a big education challenge ahead of us around this in terms of at least whatever rules get passed, that we educate people how to take advantage of them, how to be a part of this, not just simply be in the bleachers around this. So it's such a monumental challenge, and I get overwhelmed thinking about what we really need to do. But, change is happening, and rules are going to get relaxed, and AI is going to play a major role in our society. And what does that look like? And how does that impact the everyday person? And who's thinking about that? And what does it mean to be human after AGI, right? What do we do how do we make our money? What do we do with our time? Right? How do we, these kinds of basic questions have to be explored.
It's interesting because this takes me back to my college conversations with my friend Louis, because when you talk about, the risk and how do we make sure that people, that it's not, the game doesn't get rigged, right? And, my argument to him back then was always, hey, listen, if you study history, right, maybe that's what has consistently happened, right? I mean, whatever the technology, technology provides the opportunity for democratization, but, there's an argument from a political science, social science point of view that the powers that be are not, don't allow that, right? I remember and sometimes technology plays a part in that. I remember my early days as a lawyer, we represented, my partner at the time had some friends, there's a bunch of these guys mainly from New Jersey who were traders on the floor of New York Stock Exchange. Basically, families handed down these positions to generations. And we knew all of the garbage that used to go on back then, before it was much more digitized, whatever, front running tickets and, all this stuff that they would do that would be corrupt.
Yeah.
Not to mention inside information, trading on inside information. Then I had a buddy who helped write some of the first program trading systems for First Boston and UBS. Like they were like ancient compared to what these systems could do now. And back then, when he explained to me that these computer programs could trade hundreds of millions of shares based upon anomalies in the marketplace in split seconds, right? I was like, okay, I get it. Like, I can't compete with that. Yes, I can take a bunch of money, put it in a diversified portfolio, have it managed, and then get % a year or whatever it's going to average over time, right? But like, I'm not going to, and that had me like direct my attention more towards real estate for a while because that was a less efficient market, right? And so it's interesting to look at. I mean, this idea that you talked about assuring, or trying to protect the ability for it to be democratized. It's a really interesting conversation because obviously from a technology and other point of view, it's there, right? It's easy.
Yeah, it is.
But the question is, whether it's by regulation, whether it's by technology, whether it's by just power, whether that's going to continue to be an opportunity.
Yeah. And then, and if you take a look at, we've made sports betting legal, right? Yeah. Where prediction markets are like booming, right? So we are, training our young people of like fast moving money and dopamine hits. And, that's okay. There's a short-term win there for, I guess if you own the gambling stocks or whatever, but it's a long-term loss for society when we're teaching everyone to consume their wealth, not cultivate their wealth.
Yes.
And the thing about venture investing is that this is a cultivation game. You're cultivating wealth, right? You're dropping seeds into the ground. And this miraculous thing called the universe ends up like bringing something back to you that, it's just like, whoa, I remember I had just recently, he's still in my portfolio, but a young man, he was never in my class, but he talked to me about, he wanted to do something in the travel industry. And I'm like, I don't get it. That's such a hard space to be in. And it's going to be capital intensive. But I'll tell you what, here's $5,000, go figure something out. He did not do anything in the travel space. He did something in the AI space around Shopify sites. And he just raised $8 million at a $55 million valuation, right? But the bet was, he's just the kind of person I don't think is ever going to quit. Yeah. And that's the bet, right? And so a $5,000 investment now is worth over $200,000, right? How many people would love to have that opportunity?
Sure.
Right? But it could have been 500 worth 20, right? Or 50 worth 2, or whatever the multiplier is, right? And that's the game of venture, right? It's just get a little bit of the stake in multiple opportunities and see what comes back your way.
Yeah. Love it. And so listen, I teased it in the opening, so I can't, finish this podcast without talking about your Shark Tank experience. Right. So tell us a little bit about that story.
So a former student, he was in my class and he had a coat checking business in Bloomington, Indiana. And he was so mad that he lost his brand new North Face jacket because he went out on the dance floor, comes back and his jacket's been swiped. And he's like, well, why don't they have a coat checking business here? So he decides to set one up. And then he wants to set up and do coat checking as a business following graduation. Like, well, this can't be a cash business because if you, like the minute you turn your head, you're going to have people like swiping, they're going to be pocketing that cash. And you got to have a system to deal with the lost jackets. So I was, again, the first investor, and we built a coat checking business on the brand new iPads that had come out, right? So we built an app literally around coat checking. And then he's such a, big, magnanimous personality, and he wanted to go on Shark Tank. So he put together a video and he got on Shark Tank, and I elected not to go on. I elected to be the phone a friend. And so he went on and he pitched. He got an offer from Mark Cuban. I was like $250,000 for like a 35% stake. And he talked to me about that. And I said, well, you've got, now collectively, we got about $100,000 worth of safes, and that would have to convert in on that. You're going to own less than 50% of your company. Is that what you want? He goes, I know it's Mark Cuban. I said, I know, man, I hear you, but I would love to have Mark Cuban and be on a cap table with Mark Cuban. But do you want to give up 50% ownership, for this company? He's like, what would you do? And I said, well, if I were you and I didn't want to give up, I wanted to, really build this, I wouldn't give up that much ownership. So he goes back and he passes, and everyone's shocked. And so we kicked off season 4, first episode of season 4 of Shark Tank, where he said no to Mark Cuban. And then he got on news channels everywhere, like, you said no to Mark Cuban, but he's on his way of building a very big company right now. So he made the right decision.
I love it. And listen, the publicity from saying no to Mark Cuban, I'm sure helped that journey. So.
No doubt.
I love it. It's interesting. I did a solo cast, I don't know, maybe about 4 or 5 months ago on my love-hate relationship with Shark Tank as a lawyer and, an investor, right? Because it's been phenomenal to expose people to, about entrepreneurship, about investing, about things like that. But it's also creates so many unrealistic views, like, real investors don't put 24-second shot clocks on, having to accept an offer. And the other thing that's a pet peeve of mine, and I think there's a podcast called The Pitch, which I really like, which does a better job of this, which is, they give you some updates on Scrub Daddy and, some of these other ones that did really well. But most people don't realize what percentage of those deals never go through that, that we're committed to on the show, right? And that's just, that's nothing about the show. That's what happens in due diligence a lot of times, right? On deals. So in any case, I won't dwell on that, but I think it's, that's why I say I have a love-hate relationship with Shark Tank. I think it's great in so many ways, but also gives people an unrealistic picture.
It's no question, it's great entertainment, and it has exposed a lot of people to sort of the startup world. But to your point, the deals can be a little bit insane, and most of those deals, I think over 50%, never come to fruition.
Yeah.
So yeah,
that's exactly right. So listen, anything else as we have the last 5 or 10 minutes here? Listen, we could speak for hours, right? We're not. But so I'm going to ask you to open and the question and just whatever's on your mind, whether it's about your experience and things you've learned, with all the investments you've done, or, where this company's heading, or any other trends you haven't talked about, like anything else you really want the audience to know.
I would just say that for the audience, don't be so intimidated by startup investing. Take small steps, get yourself into financial games, right? That's the thing that I really try to tell young people is get yourself into as many games as possible. For example, when I heard about Bitcoin in 2013, I bought a little bit of Bitcoin just because I wanted to watch that game, right? Turns out to be a very smart move, right? But even now, people could just buy a bit of Bitcoin as an example, so you can watch it and you're paying attention to it, right? That's the kind of the thing that I think is just so important about cultivating wealth, is to get yourself in games, wealth building games, where you're patient, you're watching, and you're learning, right? Don't overspend, don't go crazy, don't try to win overnight. Look at this as a 30 or 40 year horizon. Warren Buffett did not create 99% of his wealth was created after the age of 65. 99% of his wealth was created after the age of 65.
Amazing that.
Right? And because this is a long-term game, right? Money is a tool. It's not an end-all be-all, right? But I think we've had so much happening on social media and so many influencers about running around with Ferraris, trying to, present these images of success and everything, and people fall into that trap. And, I just really think we as a society need to get back to this idea of cultivating wealth, cultivating family, cultivating those first principles that have made our country a strong country to begin with, right? Everything is just so fast. People and they're not happy, around that. So it doesn't have to be startup investing. I just would love to see people develop just a cultivation mindset.
I love that. And I love the fact that you're talking about investing and venture investing or whatever, and a long-term conversation, right? Because a lot of people think that world is all about the short term. And listen, don't get me wrong. There are certainly, funds. There is sort of pressure to exit, and there is a time frame, especially with funds that are investing and things like that. So there is that part of it. But what I love is that you're focusing on the education part. I think back to, I've mentioned him before, my friend David Bach, friend and client David Bach, who wrote Automatic Millionaire and all these best-selling financial books, much more on investing in the stock market and the benefits of compounded return. And he had Grandma Rose, and Grandma Rose bought him a share, stock when he was a kid, right? And that's what got him into wanting to understand and learn about stocks. I didn't have a Grandma Rose, right? I had lower middle class parents who weren't later they did, and they did okay. They did all right. But when I was growing up, my parents weren't invested. So nobody taught me about the stock market, about investing. Right. And it's a similar conversation, right? Just having that exposure and him, wait, I own some stock. What does that mean? Learning about it, learning about the investing, learning about the compound returns has obviously served him personally well, but also allowed him to educate folks about investing early and learning about stock market investments. So I see this as very parallel, and I love the fact that you're focusing on the opportunity to get in at reasonable amounts and use that as a learning experience to focus and learn what's going on there. So yeah, I'm excited about what you're doing.
Well, appreciate that.
So people want to learn more about what you're doing. Where do they go?
Just go to Doriot.com and send us a note and sign up to become a venture staker. And we're in sort of a beta test right now. So if you just want to explore, and once you sign up and you get into our system, when we find a really interesting opportunity with a founder who's just getting started, you get the pitch, you get to look at it and say, hey, you want to put $10 towards this, 25, right? And now you're in that deal, and now you start tracking that opportunity. And then the next founder we see, we send you another email. Here's what they're doing. And you decide whether you want to stake them, right? And so you just keep doing this, and then you'll start seeing the cream rise to the top. And then you get invited to real parties, because you were there first.
Love it. So that's Doriot.com, folks. So definitely check that out. Gerry, my final question on the podcast is always about my highest value in life, which is freedom. And for me, that means everything from freedom around the world for people from oppression to why I've been an entrepreneur for decades and haven't had a boss. What does freedom mean to you, and how does it impact your life and business?
I think freedom, that means to me, I agree with everything that you're saying. Freedom for me is freedom from a scarcity mindset. And there's so much where we look out here and it's all like everything is around scarcity, right? And to let go of that and to go inward and realize and see how abundant things really are, and let things come from inside. Being free from a scarcity mindset is so big for me.
I love that answer. You and I are so aligned on that. I come from an abundance mentality, and listen, we can spend a multi-hour podcast on all of the ways that society, advertising, powers that be, whatever, try to keep us in a scarcity mindset and why, but we won't. But I absolutely love that answer. Gerry Hays, thanks for being such a great guest on the DealQuest podcast.
Appreciate it, Corey. Thank you.
Thank you for joining me on this episode of DealQuest, where we help you understand how deal-driven growth can be your ticket to freedom. If you are interested in finding out more about my law firm, the services we provide to entrepreneurial and growing companies across industries all over the country, and my partner Brian Megan and I, and my amazing team, just head over to kupferlaw.com. That's kupferlaw.com. And if you want to follow more of my content, head over to my LinkedIn page where I post regularly. I'm Corey Kupfer. Until next week, wishing you the freedom and financial prosperity that I know your DealQuest will bring.